Markets have given up a lot of gains, the morning gains, the cheer because of the crude fall, and Nifty seem to be taking support at the 15,400 level or thereabout, same as the Bank Nifty around 33,000. There is a lot of support. In fact, yields have eased 22 basis point in the last 4 days because of crude falling. That was also powering the banking rally. Autos seem to be in favor today. In fact, Hero, Moto, Maruti, all of them are gaining because of commodity prices coming down, crude coming down. That's the essence of the market, but a bit volatile for sure. Let's take the discussion forward with Nilesh Shetty, who's also joining us today on the show. Nilesh, long time, nice to see you on the show. Let's start by analyzing your thoughts on the way crude, which was really holding out for so far out of other commodities, finally eased off. It may not have gone into a desired level, but anything below 110 is way better than levels seen 135 odd. Is the market pricing it in yet or not quite?
No, I mean, if the view of the world is that a large part of the world is entering recession, it's difficult for me to believe that it will not fall further. I mean, there has been a big rally driven by a lot of issues, including rebound in demand and supply chain. I assume at some point issues on the supply chain side will be resolved, which will ease off some of the pricing increase that we've seen. But if you genuinely see demand destruction from the developed world, I expect it to be a lot lower.
So, is the fear justified of the market that the world is going into a recession? Or let me reframe my question. The worries that the world may be entering a very slow growth phase and will be impacting relatively better off growing countries like India as well. Is that a bigger issue, or we should be happy because that will bring crude oil, which is the biggest pain point for our economy, much lower? Which side would you tilt on?
I mean, the developed world is on a very different cycle than some of the emerging markets like India. So when the developed world was booming, India, because of issues internal to it, including large buildup of NP on the banking side and genuine rural distress, was actually seeing a sharp slowdown in GDP growth and demand. And it was due for a natural economic upcycle, but because of COVID, it got delayed. Now the developed world, especially after COVID, has given such large stimuluses and especially transfer of wealth that happened to the end consumer, which is now being withdrawn. So there is very high probability that growth rates will slow down there, which is unlikely to happen in India. India is looking at the start of an economic upcycle, which should have probably started 2 years ago, but because of COVID got delayed. So even if the Western world slows down, which we think is likely, it's unlikely that Indian growth rates will slow down materially. I think India is looking at least 4-5 years of very strong GDP growth rate, purely because the cycle is normalizing for India after 7-8 years of economic downturn. So it is correct that the Western world will see a slowdown, but India might be on a very different cycle compared to the West.
Correct. Nilesh, what are your thoughts on inflation? It has already started eating into corporate India's margins. But yesterday, a comment out of the MPC commentary, one comment which stood out in my eyes was RBI DG Michael Patra's commentary, saying that by FY24, don't be surprised if crude falls to 4%. In fact, 6% is when he's expecting inflation to fall to in the fourth quarter 23 itself. And the contributors to inflation is already on a slippery wicket. When do you see market factoring in lower inflation levels?
Yeah, I mean, that is correct. If there is a recession in the Western world, which starts impacting demand, you will see commodity prices coming off, which will naturally bring down inflation globally. Plus, like I said, there are issues on the supply side which are still not normalizing. If that normalizes, that itself will see some pressure coming off on the commodity prices. So going forward, perhaps what we've seen over the last sort of 12 to 18 months, you will see a lot of easing on the commodity prices, which is natural. Every time you see a boom and then you see correction in commodity prices. So at least we expect commodity prices to be sort of a lot, at least the inflation environment to be a lot easier than what we've seen in the last 12 months. So I don't expect interest rates to move materially higher. What we've seen is the easing that you saw because of COVID in the interest rate, especially in India, we are just getting back to a normalized interest rate environment. Whether they tighten that materially, we'll have to wait and see. But you will see some easing off of inflation pressure once commodity prices come down.
Nilesh, how are you positioning for domestic economy related part of your portfolio, especially deep cyclicals, which have not really moved a whole lot? Say autos, for example. Autos are outperforming today. Auto ancillary, the commentary from the auto universe and auto ancillary seem to be suggesting things are turning. By part of it is getting reflected in the stock prices as well. Even capital goods, for that matter, the commodity prices coming down is a beneficiary there. How are you positioned here in your portfolio? Have you started raising your weights here?
So as you know, we follow a value style, and auto is one of the deep value pockets available. If you look at valuations there, no matter what time periods you look at, they are trading at close to sort of bottom of their valuation bands. And so we actually continue to have a large weight there, specifically in the two-wheeler space. We have a large outsized position there. Again, if you look at the numbers, they are back to a decade ago numbers, primarily because the market had to digest the price hikes that happened over the last 3-4 years. But we think we are sort of at the cusp of a sort of upturn in volumes there. And if your volumes do genuinely pick up, and one of the big drivers is the replacement cycle, which has been elongated because of shocks to the economy, perhaps you will see some of those buyers sitting on the sidelines, jumping back in and replacing some of their old vehicles. And of course, a lot of the offices are still hybrid and colleges are still not back to 100%. Once that need for mobility kicks in, a combination of factors will see auto demand pick up, especially where valuations are. We expect that bucket to do really well over the next 2-3 years. So we have a fairly large overweight position.
That's nice to know. In fact, you're right. I was speaking to some of the analysts, and they're already bracing for record levels of OEM sales for the month of June itself. In fact, when we spoke to the FADA, which is the Automobile Dealers Association, they also said that almost 8.5 lakh vehicles unmet demand is there, and things are moving now. All this chip shortage and logistics issues also solving. So all of that may be seen in the June sales numbers. What about capital goods? Especially the mid-tier capital goods, the bearing companies, the Elecon Engineering, AIE Engineering, all these mid-cap engineering companies, which actually are capital good feeders to larger capex cycle. How do you like this universe?
Unfortunately, a lot of them don't meet our liquidity criteria. We have a minimum liquidity criteria, and most of these companies tend to trade below that for us. So they've not come in our filters. But if there is a cyclical upturn due, you will see that bucket do really well. Now you have to pick and choose quality of management because it is filled with companies with not that great management quality. So you have to be very, very careful who you want to buy in that bucket. But I expect that bucket, if genuinely there is an economic upcycle in India, which we believe is due, primarily perhaps you will again see a sharp pickup in infrastructure spends and capex cycle. Then I expect capital goods as well as ancillaries to those capital goods will do a lot better.
In fact, talking of cyclical, we were talking of cycles. We were speaking with SBI today, and he was the MD of SBI was referring to credit cycle coming back. He was telling us that capacity utilization in the system has gone up to 75%, and inquiries on new capex related loans have gone up. And we also, you must have seen the credit cycle also coming, credit growth in the system coming back to 3-year high of almost 13%. Does it give you comfort to own more of corporate centered banks in your portfolio, be it PSU or private?
Yeah, we do have some allocation there, but we have to be careful because of the price inflation that you're seeing over the last 2 years. Just the replenishment of the working capital itself will drive credit growth. So it may not be genuine reflection of underlying demand for capex spend. It could just be a inflation-led replenishment of working capital, which is driving that credit growth number. But we do expect over the next sort of 12 to 18 months at some point, companies getting serious about capex. You are seeing anecdotal evidence of that in 1 or 2 sectors, but still, at least whenever I've met banks, there is no broad-based need felt by corporate India show a sharp improvement in capex spend. They're still very careful and watchful and sitting on the sidelines. But I expect that will change over the next 12 to 18 months once utilization levels hit a certain threshold. We do own banks, but most of them are on the retail side. Corporate capex driven banks, we have to be careful because a lot of them are serviced by PSUs and quality of management is highly suspect there. We tend to stick more, or at least our weight is more on the private side at the moment.
Fair point. What about commodities, refining? GRN went to record highs and refining stocks have started retreating. Commodity cycle seemed to have peaked and a lot of all this lead, zinc, copper, all of that multi-week low. Did you reduce your weight? Did you manage to reduce your weight on pure commodities in time? Or are you actually expecting a rebound and the average realization to be healthy and hence holding them?
That's correct. So somewhere at the end of last year, we started trimming a lot of these. We don't have a lot of commodities, but whatever we had, we trimmed significant portion of their weights, primarily again on valuations, because in cyclical upturns, their valuation starts trading at premium valuations compared to their historical bands. We've trimmed that and we are waiting patiently. They've corrected quite sharply. Actually, a lot of the companies, even though the price correction perhaps does not warrant the kind of share price correction that we've seen, if the price sustains, then there might be some opportunity for us to add more. But we have to wait and watch where the commodity prices end up. If they end up lower, you might see a bit more pain in that bucket. But we have trimmed our positions in the commodity space.
What about small and mid caps? The kind of correction we saw, I mean, yes, we know that small mid caps is more bottom up kind of a opportunity, but the average valuations of that universe, have they corrective enough to really start looking for value there, or not quite?
Yeah, I mean, that entire space, again, because we have a big sort of weight on corporate governance, to get quality managements at valuations that we are comfortable with has been a big challenge for us. So even after the corrections, the better run companies with great franchises or quality of business, they still continue to trade at very premium valuations. You will get value in companies where perhaps quality of management is suspect or the business models are not that great, which is not a space that we want to own. So I'll still be careful. I don't think there is that great a value that is emerged in that bucket as yet. Again, because they had this massive rally and now they're seeing a correction. I think investors still need to be careful in that bucket.
All right, Nilesh, we'll let you go on that one. Thanks so much for your time. Have a good day ahead.
Thank you so much.
That was Nilesh Shetty of Quantum and speaking about the way they are looking at markets and various areas of the market. Time for a short break. When we come back, get your big voices of the day. Don't go anywhere.